This is question number 10 of homework 1 for chapter 2, problem 2-22. Blue Diamond Industries had the following operating results for 2017. Sales equals 30,060. Cost of goods sold equals 20,010. Depreciation expense equals 5,460. Interest expense equals 2,940. Dividends paid equals 1,700. At the beginning of the year, net fixed assets were, current assets were, and current liabilities were. At the end of the year, net fixed assets were, and current assets and current liabilities. The tax rate was 30%. A, what was the net income for 2017? So let me use Excel and build the income statement to figure out net income. So for income statement, we start from sales. The sales is right here. So I can just copy the number, sales. And our next item is the cost of goods sold, right? COGS. That's the, also copy it into my Excel. And next item is the same that we don't have selling, general, and administrative expenses. So the other one is simply the depreciation. So just dip. So depreciation is the right here. So now I can calculate the EBIT, which is sales minus cost of goods sold and minus the depreciation. Now, next item is the interest, right? Interest, and still copy this number. And so their difference becomes EBIT minus interest becomes EBT, earnings before taxes. Sorry, it should be this number. Minus the interest. And now with the tax rate, I can calculate the taxes, right? Tax rate is, no, it's 30%. So taxes will be based on EBT and then multiplied by the tax rate. And their difference becomes net income. Bottom line of our income statement. So it's EBT minus the taxes. And from net income, we know part of it will be paid in the form of dividend. So dividend is 1,700. And you can notice that actually the dividend here is higher than net income. We have another question asking us whether this is possible. And indeed it is, because the net income here is not necessarily cash, right? The dividend is cash. So as long as the firm has enough cash available, it can still pay out this level of the dividend, not worrying about this net income. But with this dividend, we know that actually the addition to retained earnings, we know it's the sum of dividend and addition to retained earnings will be equal to net income. So in this case, addition to retained earnings will become a negative number. And that means the firm actually is not added to its existing retained earnings. It's extracting a portion of it in order to pay this dividend. And we also provided with actually we are done. We are done with the first part. I'm doing more than that now. So net income is just copy this number back to connect. And part B, what was the operating cash flow for 2017? Oh, by the way, I choose to use Excel also because this automatically meets the rounding requirement. Do not round intermediate calculations. So the operating cash flow can also be pretty straightforwardly calculated by, because we know the formula to get the operating cash flow is that we start from EBIT and then we add back the depreciation, right? Because depreciation is not a cash outflow, but we subtracted it in the income statement as if it is a cash, as it's an expense. So we need to add it back, and then we need to subtract the taxes. So this is my operating cash flow. Copy this number back and see what was the cash flow from assets for 2017. So cash flow from assets, if we check my lecture slides, you'll find out the formula. Cash flow from assets is right here. It's operating cash flow minus the change in net working capital minus the net capital spending. So in order to figure out the cash flow from assets, now we know the operating cash flow. We also need to know the change in net working capital and the net capital spending. And that's what the other information provided in the setup can help us. So we are provided with the net fixed assets for both years, beginning of the year, end of the year. And then we can do a change. So net fixed, let me write down the number first. Net fixed assets and equals, go back, net fixed assets at the end of the year, net fixed assets is right here. I shouldn't use equal sign, just copy that number, that's easier. So net fixed assets, begin, still copy the number at the beginning of the year. Net fixed assets is this number. So now I can do the change. Now go back to my formula. See that two ways to get net capital spending. First is changing gross fixed assets, but here we're not provided with the gross fixed assets, so we can use the second way, the change in net fixed assets plus depreciation expense. So depreciation expense is from the income statement. And then we can calculate net capital spending. That's the big end minus beginning plus depreciation from the income statement, depreciation. And then we also need to get the change in net working capital, right? Net working capital. So to do the change, we also need to know the levels. So NWC is defined to be the difference between current assets and the current liabilities. So for the level at the end of the year, it's the current assets, this number. This is this number minus the current liabilities, this number. So that's my level. Yeah. Double check the numbers. Yeah, this is correct. So NWC begin, similarly, that's the beginning of the year, the current assets is right here. It's right here. And the current liabilities is right here. It's right here. Some format issues, but no problem. So now the change is simply the ending NWC minus the beginning NWC. So now I know net capital spending. I know, let me mark this in red, in yellow, so you know the numbers which are relevant here. and I know the operating cash flow. So then I can calculate the cash flow from assets. We start from operating cash flow, and then we subtract the NCS, net capital spending, and then we subtract the change in net working capital. And this turns out to be a negative number. So negative here means that rather than paying its investors, the firm actually is collecting money from the investors over that year, 2017. So that's what this negative here means. D1, if no new debt was issued during the year, what was the cash flow to creditors? If no new debt, so we know that there are two types of cash flows to creditors. One is the interest, right? For the firm, that's an expense, but for the creditors, they get the interest as an income. And the other source is the issuance of new debt. So when the firm issues new debt, the firm is collecting cash from the creditors, but the creditors are paying cash to the firm, so that enters negatively. So that's why if you check the lecture slides, you'll find out the formula for the cash flow to creditors is that it's the interest. Here is retirement of the debt, so that's the other way around to what we just analyzed, and this enters positively. If it's the issuance of new debt, then this is negative. So it's the interest minus the net issuance of debt. But the setup here actually says that if no new debt was issued during the year, so that means the second term turns out to be 0. So the only cash flow that matters, that's relevant to creditors in that year, is the interest. And the interest, we can just copy the number. The interest expense is right here. And finally, if no new debt, the same setup, what was the different question? What was the cash flow to stockholders? So creditors have two types of cash flows. Stockholders also have two types of cash flows. Creditors receive interest from the firm, so stockholders receive what? They receive dividend. So the first type of the cash flow to stockholders is that is the dividend. So that enters positively. The second type is similar to the second type of the creditors, the cash flows to creditors, is that the firm can also issue new stock over that year. And when the firm does that, it's collecting money from the stockholders, hence that enters negatively. But the problem here is that in order to follow that path to figure out the cash flow to stockholders, we need to know the beginning level of the equity, level of the stock, and the ending level of the stock. But in this question, the setup doesn't tell us such information, so we cannot use that path. But we can use another path, which is what we call the cash flow identity. So this is similar to question number 4, right? So this is what I wrote for question number 4. So cash flow from assets equals cash flow to creditors. B is bondholders plus cash flow to stockholders. So that this is called cash flow identity. And from the cash flow identity, I can figure out cash flow to stockholders by the difference between cash flow from assets and cash flow to creditors. So that I can do that calculation here. Cash flow to stockholders is simply the cash flow from assets minus the cash flow to creditors is right here. Just copy that number back. And this turns out to be an even larger negative number. So this means that on average, the firm actually is collecting money from the stockholders over the year. But for the creditors, the firm is paying on average the cash flow to its creditors. So now let me check my work. All right, so we got every part right.